Hi everybody, once again this is Kevin Berju from Centennial Lending Group. I'm the branch manager here and wanted to go through another kind of mortgage minute, although the reality is this is going to be far longer than a minute because what we want to do is explain to you the circle of life in mortgages. It sounds complicated. No, we're not going to hold Simba up to the sun and say, here you are. It is a little Hakuna Matata though. So here's what happens with mortgages and here's how that great circle works. So let's start off with the premise that you're going to take out a loan. Okay, so let's say you're taking out a loan at 4%. Now, again, that's like an income stream. So anybody who buys that loan, who gives out the money and says, okay, I'll lend you this X amount of dollars, they're going to get an income stream of 4%. Let's say they don't really want to hold on to this. They want to sell it off and get their piece. So you come to a company like CLG. And you say, I want to give you a loan. And we say, okay, here's the loan, 4%. But we don't want to hold on to that loan. The reason we don't want to hold on to that loan, because we could take that same money, and if we're very good at what we do, we could sell that money anywhere between 4 and 6 times in a year, maybe even more. And at the end of the day, we get paid a service fee to do that, and we still have the money, which isn't even our money, it's a line of credit, but that's a different story altogether. So we have 4%, and we say, okay, we're going to bundle all the loans we got at 4% this month, and let's say it's $20 million worth of loans, and we're going to sell them to Chase or Wells Fargo or Ditech or some other bank. It doesn't really matter who. So they're going to pay us out. Because they're paying us out, instead of earning 4% now, they're going to earn something like 3.75%. Okay? Still a good return. And they have hundreds of us. So they're getting $20 million from CLG, $20 million from this person, $20 million from that person, from that company. And so, at the end of the month, they may have $2 billion. Like, okay, we've got this $2 billion. Now, what are we going to do with it? We don't want to hold on to that. So what they do is they then bundle that together and sell it to Fannie Mae, which is, by the way, since Fannie Mae holds the loans, they get to write all the rules. Golden rule. He with gold gets to write the rules. Okay. So now, Wells Fargo or Chase or whoever it is says, okay, we want to sell this now they've got $2 billion, so we want to sell this to Fannie Mae. They sell it to Fannie Mae, and Fannie Mae says, okay, we're going to pay you out. So now, because we've paid them out a sum of money, our income stream is about 3.5%. And you know what? We don't really have the capacity to monitor the loan, to administer the payments of the taxes. So guess what, Chase, Wells Fargo, Citibank, what we're going to do is we're also going to pay you a little bit more. We're going to pay you a quarter point a year to do what's called servicing the loan. Okay, so now that's great for Wells Fargo and Ditech and everyone else, and it's good for us. We've all gotten paid. Fannie Mae is now holding the loan. So now let's say they're earning 3.5, maybe 3.375, and these aren't real percentages, but they're just used for illustration points. So, but keep in mind, Fannie Mae has Ditech, they have Wells Fargo, Citibank, so they're getting in billions and billions of dollars each month. Okay, so eventually they're going to run out of money. So what do? They say, okay, here's what we're going to do. We're making 3.375. What we're going to do is we're going to sell a mortgage-backed security. So if people come buy this, let's say you or I, say we want to make an investment. We want to buy something that's relatively safe, pays a little bit. It's not going to be great. It's not going to be a stock that's going to go forever, but we're not going to lose our shirts either. So guess what? We buy this, and it pays us 3%. So Fannie Mae actually makes the difference between 3 and 3.375. So you've paid 4%, but in the end, you've actually bought the loan back at 3%. So it's a great circle of life. Now, the reality is that they're bought by fund managers and hedge managers and all that to balance their portfolio. But you probably could go out and get a Fannie Mae-backed security of some sort, in which case you are funding your own mortgages. Thus, Hakuna Matata, the circle of life. We hope this helped. If you have any questions, please feel free to reach out to me, 215-681-3587. Once again, Kevin Berju, Centennial Lending Group. Thank you very much. Have a great day.